Thanks for coming. Welcome back to the good old days. We're going to go through what I'm thinking in terms of where the market is now, what I'm looking at, what you should be looking at in terms of due diligence, and then at the end, if you stick around, a couple of companies I think are worth acquiring. It's the usual thing, rocks. Normally I focus only on the geology and a little bit on the rest, but this time, given what the market's doing, management, share structure are just as important, if not more so. So this is what we're going to do today. This is how I started last year off, a lot more cautious. And what I showed here is from 2008 to 2011, some of the stocks that really, really ripped. Here you can see Caneco was up 12,000%. Others were up a few thousand, 9,700. And how they ended up at the end of this, delisted 34 cents, acquired for 34 cents. So this is going to happen in this market as well. We're going to see a lot of stocks go way up and they're going to go way down. Without doing the proper due diligence, I'd hate to see you get stuck on the bottom end of this. But this year, all the experts, including myself, I guess, have been harping on about how well the metal price is doing, how good gold's done, how good all your stocks have done, etc. And these are the gains last year, and you can see they're quite well. And what I show below are two of the stocks that I own that did, I think, the best. Lundin Gold up 1,300%. Southern Cross up almost 1,000%. But now we're looking at Lundin Gold with a 27 billion market cap. Southern Cross, a 2.7 billion market cap. Are those buy, sell, or hold? What's the odds of those things going double again? I think low. So what I've been doing is selling enough money to get my money back, taking some profit, and looking to roll back into earlier stage projects. So I think that's where the market's going to end up within the next year or two. And the TSX Venture Exchange, again, it's up. The financings are up about 114%. Market caps are up 59% of the total TSX Venture. But we're still, new listings were down last year. And so we're not seeing a lot of stuff coming in yet. I think we will after this show. But it still hasn't moved, in my opinion. And you look at what the miners are producing gold for at the mines, it's like $1,600 an ounce. And the free cash flow yields, which is what really kind of matters, are 7 or 10%. You compare that to the average S&P 500, that's 2.5%. So these are attractive still to investors. All right, new money coming in. That photo, I just got out of Saudi Arabia. I was overlooking at some projects, and then there is a big metals investor forum going on, and you can see it's a pretty flash place. But what I noticed and what I've been talking to people here is the generalist funds are beginning to step in. Family funds, offices, they're moving in. Tether buying gold, royalty companies. I think the realization has finally hit that we are not finding and bringing into production enough metal to replace what we're mining. And that's I've been yelping on about this for years now, but I think it's finally taken hold, and we're going to see major banks, funds, etc., start to buy into this sector with that realization. That is the bottom line. And the world, it's on fire. So it's looking good, assuming things don't go bad. Okay, number one, who's running the company? Here's some red flags, and I think, we're bound to see the grifters and cockroaches come out. Does the person running the company have a consistent record of failure, bankruptcy, scams, lies and misleading statements, overpromising and underdelivering constantly, untethered to facts? That's popular these days. Irrational belief in the value of a property, disrespected by peers, subservient board and members, employees. This dude. If someone like this is running the company, get the hell out. Unfortunately, I'm stuck in the States still. Okay, who owns the stock? Share structure does matter. because exploration and discovery take a lot of time and money. If you're lacking a committed and educated shareholders, usually means the company is forced to focus on short-term pumps, re-drilling holes, that sort of thing, while continually diluting shareholders and the share price. So shares outstanding, fully diluted, the tighter the better for juniors. Large management and board insider holdings. You want them up in the 20% plus. Who are the top 5 non-reporting shareholders? That's really important. It'll tell you if they're in it for dimes or dollars. What's their long-term plan? Are they committed? You need committed shareholders because that allows you time to do the proper exploration, to test your theses, to revamp your thesis with new information comes in, that sort of thing. Flow-through financing, I consider it a negative. Usually it's for a tax break. I know it helps raise money, but also if you're an American, you're kind of on the downside of that twice. I don't like it. And I show a chart down here of a company that put out what I thought was a highly speculative release of the top 140 meters of a drill hole, and then the bottom 140 meters came out and there was nothing in it. So you see what happened to that. All right, where exploration and mining companies fail. We know the odds are real low of any prospect actually becoming a mine, like 1 in 1,000 plus. A study by Burgess Mining Consultants shows that 5% of prospects reach exploration stage, 0.5 reach PEA stage, 0.3 reach the pre-feasibility stage, and 0.2% actually achieve full feasibility. And these technical studies, it depends a lot who does them, and it's also important to remember that what the accuracy is. For a PEA, you're looking at plus or minus 30 to 50%. PFS, 20 to 30%, and the feasibility, 11 to 10%. So there's still a lot of uncertainty in these things. And I think the preliminary stuff is bound to be more optimistic than the full-in feasibility. That little chart below, years to peak share price, this is put together by Doug Silver. I found it interesting. What it shows is from a company listing over the 5 years, the highest the share price usually gets is in year 1, and you can see it drop off after that. So keep that in mind too. Geologic reality, it does hit hard, and it does matter. I think it's one thing I see a lot with geologists, myself being one, is over-optimism and not recognizing when it's time to quit. It's really important. If your thesis isn't working, you're not hitting, don't try and keep going because you told everybody you're going to keep going. Quit. Move on. Does that make sense, Caleb? All right, let's talk about open pit and underground mining. What characteristics determine profitability? Here you can see the big pit in Australia, and there's a real nice vein in Fiji. Okay, a mine is a terrible thing to waste. Strip ratio when you're looking at open pit is really important. And I show 2 examples here. The one on your left has a 4.4 to 1 strip ratio. The red is the ore, the gray is what is waste. That takes money. It costs money to mine waste and ore. So in this example, assuming $3 a ton to mine that, it costs $16 to mine 1 ton of ore. On the other one, where you got a much wider ore body, the strip ratio is 2 to 1. It costs $9 to mine a ton of ore. So keep that in mind when you start looking at these deposits, whether the mineralization is deep or it's narrow, because all the stuff on top or on the side have to move for a open pit. Here's a great example of a really nice open pit deposit. Snowline Gold, they've done exceptionally well. A lot of credit to that. grade, size, continuity, right from surface. Their first hole intersected 135 meters at 1.1 gram. Another one, 283 at 2.3 grams. And what you can see in the section below, everything purple is 2 grams and above. And this is the resource block. And what that tells you is the continuity and mineralization, characteristic mineralization, is spread across the whole thing evenly. That is really, really important. So that is what's going to get mined first. And that's why the internal rate of return is so high and why the deposit is so good, despite its location. That's what you really want to see in an open pit deposit. If your high grade is down here, that means all the stuff above is less, and it's not near as good a deposit. So it's real important that the high grade is mined first and near the surface in an open pit deposit. Make sense? Okay. All right, let's look at another real life example. On your right, that's 3 drill holes into this property. And what that shows is the purple are the high grade gold hits, and the green and such are much lower grade. And I ask you, looking at that, can you really connect any of the purple lines? Not very well. Look at all the green, low grade or no grade stuff in between. This is not what you want to see in a deposit, at least in terms if you're looking to mine it. Watch for smearing. This is something I talk about a lot, and if you take a picture on Exploration Insights website, there's a link to a little magic box where you can put in the long intersection, and below that you can pull out the included intervals, and that'll give you the grade of the stuff that's not included, and that's really interesting to look at. And on the picture of the core, there's outlined visible gold. Visible gold is not always a good sign, right? It depends on what is relationship to the rest of the ore body. You can have a really, really nuggety deposit, and makes it really hard to mine. Okay, so this is the one I was just talking about. What you can see here is they got 28 million ounces at 1.19 gold equivalent. It's on the side of a hill in a really tough location. The deposit, if you can call it that, dips into the hillside, and down below there's a glacier. Is this really going to make an open pit deposit? I kind of doubt it, but apparently you can see how it's done over the past 6 months. That goes back to my third slide talking about the stocks in the last bull market that went way up and went way down. Okay, let's look at an underground deposit. This is Southern Cross down in Victoria, Australia. High-grade discovery. And what this demonstrates is the vein sets itself can be followed at depth. So that tells you that there's continuity, and when you go in to mine it, you know where the ore is going to be and you can mine it. Great deposit, just getting bigger, but not cheap anymore. Gold antimony. Okay, I can guarantee you nobody else in this bunch of speakers is going to mention coefficient of variation to you. What it is a means of measuring the variability in a ore deposit. The higher the CV, the higher the coefficient of variation, the more uncertainty there's going to be in the mineral resource, and the more difficult it's going to be to pull together a resource and mine. So here I show 0.5 to 1.5. That's a decent CV. 1.5 to 2.5, okay. Over 2.5, that's pretty poor. And you get over 5, that's really poor. I show Southern Cross here. That's a piece of their core. You can see the gold there. Their CV is 1.5. So it's good. It's good. And this is not hard to figure out. When you go to the tech report on the website, do your search for CV or coefficient of variation, and it should pull up what that is in the resource estimate. So again, these are some mines that had pretty high CVs, right? Look at Pretium, that was 22. When they went in and mined it, the grade dropped from 17 to 8. Still a good deposit, but they've got to drill that thing off on 7-meter spacings. Rubicon, we know what happened there. CV6, uncapped 14, a bust. Klondike, CV7, on care and maintenance. Back River, we'll see. We'll see how that works out. Pure Gold, Madsen, when it was last mined, CV of 5, bust, too much dilution. Ascot, Premier, suspended operations, again, 3.9 CV. That tells you a lot. All right, a couple of ideas. Lower risk, higher reward, I think. North Arrow, exploring for gold in Botswana, on trend from gold belts in South Africa. Banded Iron Formation, they're north of an on trend of a 3.6 million ounce deposit in South Africa. They're drilling through shallow sand, looking for these things. They can pick it up with geophysics. They've had some initial good results. Quality team, quality science, pure grassroots. They're raising money now, or they will be shortly, to further define what they've found so far. At 8.5 million, I think it's a good spec. Standard Gold, they're in Guinea, West Africa. 120 million market cap, about 22 million in cash. But look at the shareholders: Montage, Lundin, Anglo Ashanti, insiders on 10%. They're in elephant country, 8 million ounce deposits, 5 million ounce deposits. They're showing good structural continuity along their breaks, their vein systems. 3 projects are going to be drilled. They are earning 85% of the one project. And again, quality team, quality science, pure grassroots. Another lower risk one that I like here in Canada, Quebec, Azimuth. 103 million market cap, 12 million in cash. They've got joint ventures. Look at the shareholders: Agnico, Centerra, Quebec institutions, insiders, and retail's high. Hybrid model. They generate a lot of projects, bring in partners, and drill their own prospects. Elmer's got a expanding resource. What I'm keen on right now is the Wabamis gold antimony. Assays are pending. This is a really interesting looking project. They got a joint venture with a Polish company looking for PGEs and nickel. Lithium, Rio pulled out of that joint venture. But a good team doing good grassroots exploration in a very positive jurisdiction. Another one, Headwater Gold. Market cap 48 million, 2 million cash. They've got excellent shareholders again. Centerra, Newmont, insiders own 31%, seeking high-grade epithermal systems in Nevada and Idaho. Newmont's working on 2 projects. They need to spend, I'm not saying they're going to spend this, but this is what they need to spend is 50 million to get to 65% and 85 million potential for the project. Oceana Gold just came into for a joint venture. They're spending first phase 11.5 million if they see positive results. Centerra, 2.5 million committed, pending assays on Lodestar and TJ. And the Spring Creek discovery, it's looking good. All right, closing thoughts. Basically what I've been saying is good people employing good money on good projects. It's that simple. Mining company valuations have not got caught up with metal valuations, metal prices. The junior sector is hot, obviously, but I think there's room to go. Ultimately, though, geology matters. You need to know what's going on geologically and add whatever thing you want to add there. Welcome to Science Hill, as he says. All right, this is who we are. Joe Mazumdar writes the Exploration Insights newsletter. It's about what he is buying, selling, and seeing with his money. No one pays him to say anything. He's a real smart guy. I work with him. It's his letter. There you go. Come see us. Go to the website. Thank you.